Hello, in this lecture we will define principal of a note. According to Fundamental Accounting Principles, WILD 22nd edition, the definition of principal of a note is amount that the signer of a note agrees to pay back when it matures, not including interest. When we're thinking about the principal on a note, we are of course talking about a note, a promise to pay for some type of transaction within the past, that transaction being for cash or some types of goods or services. Notes usually being longer periods of payment than a standard accounts payable, meaning standard accounts payable might be 30 to 60 days. A note's usually going to be a longer time before repayment of the principal and the interest, and therefore typically in writing, typically charging interest. The principal on that note will be the repayment that is not including interest. So for example, if we have the purchaser here purchasing ink for $10,000 and issuing a note for that $10,000, the note in this case we're saying it's not in the accounts payable, it's going to be longer terms than 30 days. Because of that, it'll be in writing. Because of that, it will also have interest charged on the principal balance. Therefore, when the payment is due, it's going to include the $10,000 that we promised to pay plus whatever interest that has been agreed upon. That $10,000 is the principal. Anything added to that $10,000 is the interest. Interest being the kind of like the rent on the money. If we paid it up front, we wouldn't have any rent on the money. If we get to pay in the future, that means we're basically having a loan, and therefore we're able to keep that purchasing power of the $10,000, and therefore we have to pay interest for that ability.